Well, here we are. September ramps up. The ballers come back to their desks after vacating in the Hamptons. And we look ahead at the non-farm payrolls number, where the possibility of market pricing is that we could be having a 25 versus 50 basis point cut debate playing through in the mix. Now, what does the non-farm payrolls number, what does the data, what does the risk tell us about the interest rate settings? What does that mean for the US dollar? What does it mean for gold and equity risk as well? Now, talking about gold, it's on an absolute flyer, as we looked at last week, and it's continued on that momentum, certainly in priced in yen and euro terms. It's on an absolute beast mode at the moment. But gold in US dollar terms continues to make stronger sense as further capital continues to chase the price higher. We look at the risks in the system, fiscal issues in the UK, which is pushing out the back end. We've got political issues manifesting in Japan, in France as well. But generally speaking, if you look at the volatility channels, they seem impervious to what we're seeing there, and volatility continues to be low. We ask what kicks us up into that situation. There's a lot going on in financial markets, a lot of trades that we like. It's the trade-off. Well, hello, Chris Weston here from Pepperstone. I'm joined in 2 seconds by Blake Moreau from Forex Analytics. And as always, the world of markets we will be discussing, looking at the dollar, looking at gold, looking at commodities, looking at equities, the whole spectrum of risk, really looking through technical and fundamental and tactical lens as well. So we're looking at all the trades that we like in this market, and who else better to discuss this than Blake Moreau from Forex Analytics. How are you doing, mate?
I'm doing great, Chris. Good to see you. Happy
September.
Thursday?
Happy seasonally bad period for markets, as they say. Bad for bonds, good for the dollar, bad for equities. But will seasonals make a steady return? And obviously I wouldn't personally trade on seasonals alone, but obviously these effects do get considered, and we look at the risks around those as well. But talking about risks, I think a lot going on. I think it's probably a good time to discuss them in Topical Thunder.
I think it's a great time.
Go. Well, let's take the market pulse right now, because we had seen a little bit of weakness coming through in equities. I think on the day that the ballers returned on the 3rd of September, we saw a little bit of down, but the buyers came back in towards the end of the day, and that seems to be the case. The dip seems to be very well supported in the S&P and NASDAQ. Apple looks beautiful at the moment. I think they've made some sort of signs about their plans for AI next year, which is certainly getting a bit of discussion. And that stock looks like it's broken out, maybe going to show some leadership in the S&P and the NASDAQ as well. We'll have to see. Volatility is still pretty low. We're not seeing a huge propensity to go and hedge. You're not seeing that in the skew. VIX 15, dropped 16% or so. The dollar's still trading a bit of a range. Euro dollar, dollar yen, they're trading a bit of a tight range. We'll see if that breaks out. Obviously, we've seen some idiosyncratic issues with French spreads blowing out relative to German bunds, and back end of the UK curve, or certainly the ultra end, moving up. But how do you see the risks permutating at the moment? Obviously, we've got gold moving up nicely. That's a big momentum position. How are you seeing the sort of general feel in the market?
Well, I think as traders came back from holiday from the Hamptons, that wasn't me, by the way.
Well, you might have been, but you just had your green screen and no one knew. But
I'm just saying when all these traders are coming back to get in front of their computers, we're going to talk a little bit about that as we get to the next couple of topics. But valuations are at the highest levels that they've been. They've surpassed levels of, I think it's earnings to price for stocks, more so than the .com bubble. So I mean, when you're reading all that and you're coming back, I think it just kind of provoked a little bit of selling. There's a lot of uncertainties right now. And so I think the market's starting to price in a little bit of that. But technically speaking, let's just understand that we're not making lower lows in the S&P, not right now. We may be consolidating at all-time highs, but we're not making lower lows, at least not yet. This week so far, we've skirted from that, from making lower lows. Now, if we drop maybe another 30 or 40 S&P points below our weekly low, then we will technically start forging out lower lows, which just isn't the case right now. I think the market's maybe getting a little premature. You're right. Seasonality is playing a role here, and it's typically not a bad time to be long dollars. It's not a great time to be long stocks, but that doesn't necessarily mean that this is the turn. this week. So I'm just kind of looking at it as kind of sideways consolidation right now.
Well, I think the Goldilocks scenario is still very much in the market. I mean, economics in the US are good. I mean, if you look at the Citigroup Economic Surprise Index, it's been going up and up and up, which tells you that when the data's been coming out, it has been beating expectations on a consistent basis. I know we've seen a bit of a cooling in the labour market. We saw that in the JOLTS report. We'll look at it on payrolls, but it's not collapsing. Labour market, the quits rates are right. I mean, the layoff rate still hasn't changed, and there's no. So a bit of a cooling in labour, but people aren't laying off, and growth is still okay. Data's beating expectations. The Fed put's still firmly ingrained in the market. The reaction function of the Fed is still very much to cut rates, and that's giving everyone a bit of a metaphorical hug. We've gone past the meat of earnings season, but volatility is still low. The whole sort of system at the moment still feels like the Goldilocks scenario is there in the mix, and pullbacks are being bought, and I don't think that's going to change things at the moment. There has been a bit of rotation in equities into value, defensive areas to an extent, but it's not been overly prolific, and so I still think people are going to be buying dips until something changes, and I think maybe we need to see a run of bad data to really perpetuate the idea that the Fed are behind the curve. I think that would be a situation that would take us down, but it's going to take a bit of time to evolve.
It's going to take a bit of time, and maybe it even takes us into this. Might as well just go ahead and move along and talk about what's happening this week with the jobs report, because it might come as early as tomorrow, or at least or at maybe Friday when we have the jobs report. Now, Chris, the reason why I wanted to bring this topic to our attention is that we have the jobs report on Friday here in the U.S. and not everybody's watching it, as you've pointed out so aptly here right on this show over the last couple of weeks. It's really what the Fed's laser focused on right now. But we do have tomorrow, we have ADP, which typically comes out on a Wednesday, so it's coming out on Thursday. We have weekly unemployment claims. We have ISM services data, which everybody's going to be looking at the employment index in the ISM. So I want to know, first of all, what your playbook is, because I think that my wheelhouse and my bread and butter is in FX, and what I see right now is that the dollar, or you could say the euro, is really, really in a tight range. The upper end of that range is 117.20. Lower end of that range is 115.75. We happen to be trading right now at 116.60, which is smack dab in the middle of that range at this very second. So at the time of filming, that is. The FX playbook seems pretty logical, but you've got gold at new all-time highs. I hear a lot of analysts are saying no matter what happens in gold, you got to buy the pullback. Even if there's a strong data and the U.S. dollar strengthens and you see gold pull back, you still got to be a buyer of gold. What's your playbook as we go into the jobs report, whether tomorrow ends up being the most important day of the week or Friday?
Buy gold in Japanese yen, XAEU, JPY. I mean, this is something we offer. And then you've got the gold price going up. And if dollar yen goes up, then you've made double bubble on that. So that probably is the place to be. And it's been up 11 days in a row now. So maybe a bit too hot, and maybe pullbacks are buying. But that's an interesting one. I think it's a tough one really, because you've got to take an aggregated view. The markets will probably key off the unemployment rate immediately. They'll probably key off the level of jobs, and they'll have a certain number in mind. Below 80,000 would probably get it done for a 25 basis point cut. The market's already pricing 88% chance that it comes in. But I think then there's a more holistic view that the rates market will also come to look at through the aggregation of the session afterwards. And, we're looking at the employment to population ratio that's started to become a thing now. It's at 59.5%. But, if that drops, that would probably be something that people are looking at structurally. The unemployment rate's obviously key when they're looking at the slack in the economy. And, if that was to push up to, miraculously, if that was to push up to 4.4%, I think what that does, if you get a really low establishment survey and revisions as well, I mean, it does bring a 50 basis point cut into the table. I don't think a 50 basis points cut's going to happen. But in market pricing, it would. There would be a premium for 50 basis point on the table. And that thing, the question then, would that be good for equities or bad for equities? I think it might be bad for equities, because even though the Fed are there, it would bring in this seed, are the Fed behind the curve? Trump have been continuously saying, you're too late. Will the market buy in on a bad number that they're behind the curve? In which case, I think risk assets go down, because yeah, there's a belief that perhaps they need to chase this market lower, and that's not good for risk when the dollar gets hit in that situation. But we can't rule out a positive number as well. And I think to take a rate cut off the table, I mean, you're going to have to see something pretty substantial, 150,000 plus unemployment rate. Oh, hang on, he's got something to say. Hit me.
Yeah, well, let's not forget that the BLS chief, she's gone. She's gone.
And there's going to be revisions. And on Monday, there'll be the annual revisions to the BLS survey as well. So that's the establishment survey, not the household survey.
That's the 9th. Is that correct?
Correct.
I believe?
Yeah.
Okay.
Or Monday.
But I mean, are you really expecting a bad number, Chris? Come on.
I don't think so.
We got Trump's got his own man in there now.
He hasn't. It hasn't been blessed by the Senate yet, though, is he? I think he is. I don't know. I can't remember.
I don't know. Is it just a vacant spot? I mean, maybe he's in there. I'm not sure.
Yeah, but I mean, obviously, if you get a really hot number, people will be like, how politicized is this? How much? I don't know. It doesn't matter either way. Look, the question is once you get the aggregation, all this stuff, average hourly earnings, the market will make up its mind, and then we'll sort of have a realistic picture on that sort of 25 basis point, maybe 50 basis point cut debate, 0 to 25. That's kind of where we want. But the initial number is going to be very hard to trade, and what the algo is going to key off, level on the payrolls, level on the unemployment rate. But as the session wears on, there'll be a consensus view, and I think that will give us a realistic situation. But you look at the volatility markets now, Blake, the forward volatility markets, the S&P. You go across last week or so, you look at all these different risk events, payrolls, CPI, Fed meeting, blah, blah, blah. The highest implied move in the S&P was over non-farm payrolls number. So that tells you that the market is really putting a lot of weight on this. Now, obviously, that is really important for our risk manager. Do you want to hold those dollar positions over the meeting, given that the risks, their massive movement or big movement is expected, and the risks are probably almost symmetrical. So, that risk management 101, I think, is the bigger impact rather than trying to prophesize where the market's going to go. It will be. The market is putting a lot of weight and volatility around that. So I think that's important. And then I'll take this one to the next point, which is the Fed credibility issue. Obviously, this idea that, Governor Cook's in the mix, and, it's gone to, she's come back and sued Trump to stay in her position. I think the likelihood at the moment of her being stood down formally and removing from position this year is quite low. Betting markets got something like 25%. But most importantly, everyone said to me, gold's reflecting this Fed credibility, this idea that Trump's going to structurally stack the governor's positions, and maybe that could have an impact on the regionals if they get it in time before the reauthorization. And that means that you've got a Trump-influenced Fed that influences policy. I don't believe that the markets are really pricing much of that in at the moment. I don't think the move in gold has a huge amount to do with people hedging against that, because it's just been recently, it's been about momentum. All the CTAs are buying, the flows are driving this up. It's been a huge momentum chase. But I justify this because the US dollar is actually higher than when Bill Pulte came out and made these accusations against Lisa Cook. It's actually higher since that point came through, right? More importantly, the rates market. If we genuinely believe that we were going to have a politicised Fed and they were going to be heavily influenced by this, you would not see the trough rate of the Fed pricing coming into a neutral capacity. The market's saying that when they get down to a low, it's going to be at the neutral point where the Fed are saying by September of next year. You would probably see a market pricing in a trough rate below the Fed's neutral rate, but actually far quicker as well. And we're not seeing that. That is why I don't think we're pricing much of a credibility premium into the dollar at this stage. It's been driven more by rates and cyclical factors. And I don't think we're pricing it into the gold market. The rates market's not pricing any political credibility issue at this stage. And I think if Cook was to go, I think markets would absolutely come alive. But that's my theory. What do you think?
Well, first of all, going back to your gold analysis, I couldn't agree more. I think a lot of gold traders are just trying to put a theme on a move that's already been taking place. I mean, they're just trying to I turned right. Why'd you turn right? Well, I wanted to go right, and my house is to the right, so I have to go right. I mean, it's silly to argue that. I think gold's rallying on for all sorts of reasons. Maybe more of a debasement type of, not a fiat
it's just
debasement
become a
type of
momentum
story.
move now, isn't it?
Right. It's like, there's a lot of reasons why gold's going up. I don't think that's one of them. I think that the Fed credibility really comes into play on who Trump selects as the next Fed chair. So, I think, if you put in a Waller, or even a Warsh, you put in a Kevin, right? I think that the Fed maintains credibility. You put in a Zervos, and everybody's going to sell dollars like aggressively. So I think the credibility point, or the credibility argument, really comes into play. My opinion is Cook's already gone, and I think the market already knows Cook's gone. Stacking and putting another Fed governor in, yeah. So they're still going to have to make decisions based on what they feel is best for the U.S. economy. Will they be slightly influenced one direction or the other? Yes. That doesn't necessarily mean that they're going to stay that course on what you think that the Fed is going to do.
I disagree on the Cook thing, though. I think there's one thing is will she go, but the timing's important because the regional Fed members, their reauthorization comes up in February. So she needs to be out, and there needs to be a Trump-friendly governor in place before that point, appointed through the Senate, for there to have a majority, so that the regional members who are appointed by and reauthorized by the governors can be influenced by that policy. That would be the point. So I don't know. I think if there was a headline out that they found legal cause for her to go and she's happy to stand down, which seems unlikely at this stage, I think the markets would. You say that they're expecting it, but I think the markets would blow up. I think there'd be a massive amount of people failing to price risk. We just say, what does this mean for the most important financial institution in the world? What does it mean for the path of policy? There'd be so many questions being asked. And as you know, in that situation, when the distribution of outcomes not just becomes more diverse or dispersed, but actually the tails become wider, liquidity comes out of the market, and you see massive volatility because it's a huge unknown for such an important subject. I think if she was to be stood down, there would just be an explosion in volatility. That's my view.
All right. Well, and I'm not going to, you make some great points. I can't really argue that. And let's I think only time will tell, right, Chris? And
well, absolutely. I could be wrong.
It seems like we're going to find out sooner rather than later.
Yeah.
So
anyway.
Price your risk and manage your risk accordingly. All right. Speaking of which, let's talk about the last theme. And this is a topic that I wanted to bring up just because I get a lot of questions in our community on the daily, especially this week. People have come in, or they're in the chat rooms. They're like, "Hey, where's the volatility? Everybody's supposed to be back from holiday, and why aren't we seeing markets go crazy?" And I think I want everybody to take a step back, understand. Like, let's say you are a manager, a hedge fund manager, an institutional manager, pension manager, whatever it is, and you did just come off of holidays. You're not going to sit down in front of your desk on Tuesday morning after a long holiday, whether it's been a month, whether it's been a couple of weeks, and you're not going to just start pressing the button. These guys are not day traders. They're not what we are. We're traders. We're like, give me volatility and give it to me now. I mean, I'm going to press the button and I'm buying 500,000 euro right now, and I'm selling another. I'm selling a yard of cable. I mean, they're not doing
We're
that.
good. They're the opposite. We're good versus good versus evil.
Right. We might be good. They are evil, or is it the other way around? Anyway, they're planning what they want to do and how they want to attack the last few months out of the year. They're looking at a bunch of schematics. They're looking at research. They're talking to their team. They're trying to figure out where the risk is. And one of the biggest risk events is Friday, if not tomorrow, in the U.S. Friday for the jobs report and the Canadian jobs report. So you got two big events coming at the end of the week. Of course, people are, taking their time. They're if you got a big, amount that you're allocating in the market, you're not going to just step in on Tuesday morning. It takes some time, and it does every single holiday season. I always call this the very beginning of our trading season is really in September. It's not a calendar year. It's really starts now. So anyway, that's where the volatility is at. Chris, I'd like you to chime in if you have anything you wanted to add to that.
Well, I think if you're a big investment manager, you're coming back from your break at the Hamptons, first thing you do, you log on, you have a look at the screens, and then you go for a nice wine, boozy lunch with your analysts and some of your junior traders, to be honest. So I'm sure that's been the case. But yeah, look, they're not going to come back and go, yeah, let's dump everything and, see the world through a completely different set of eyes. That's not going to be the case. Things don't work that way. But yeah, look, I think they might go around sort of, obviously the first thing is to talk to people and get the feel of it and, see how everything's going. And the juniors would have done a great job managing those positions and exposures. But yeah, no, things won't change. Their positioning is right within the mandate of the fund. And, I think it really comes down to the data now. So that, they've probably tweaked some of the core holdings recently, maybe taken down some of the core exposures, certainly taken down some of the lower quality end of town. The high short interest stocks have underperformed a little bit. Cyclicals a little bit underperforming defensives. And I think they've got their portfolios into the right space. So, yeah, I mean, volatility is very low. People are short volatility and that may change. So now, obviously, people go into the payrolls well positioned for that as they see fit, where the risks are. And, I think if we get a good payrolls number, a really strong payrolls number, I think that'll be well received by the equity market. It may see interest rate cuts being priced out, but I think if the Fed are telling us they're a little bit more concerned about the labour market, I think the biggest risk to the market now is a market that believes that the Fed are behind the curve and they need to chase. And that's not the case at the moment, but that would be a risk, right? So if we get a really poor number, the Fed are behind the curve, they need to chase. It opens up a small premium for a 50 basis point. That's not good for the dollar. It's obviously not good for equities. It'd be good for fixed income. But that's the way I see it. So they're going to be looking at it going, we want a Goldilocks number, 80 to 120,000 jobs, unemployment rate fairly flat, doesn't take a 25 basis point cut off the table. That's what we want for risk. Volatility stays low, bang on we go. But it's the outlier numbers that and a suite of outlier outcomes that could be that. So then people will react, and I think that becomes the issue. But right now, I think market portfolio managers obviously have their portfolios in a nice spot. Not just because they're coming back, they're going to go right. Changing everything. I'm seeing the world in a different, revitalised mind. Let's move on. But right. We'll see what happens. I think what's happened also with people talk about the Treasury market being an underperformer and having bad returns during September. Well, look, we've got the issuance comes out, the increases seasonally at this time. They come back and the Treasury Department have to issue more coupons. They increase their net cash issuance. I think it's about 75% more than we saw over the last 3 months. So they've got a higher funding task to come through, and that in itself just pushes up yield. So I think the reason Treasuries sell off is generally because the Treasury Department have to issue a lot more debt, and that probably term premium rises and the dollar probably rallies on the back of that. That's probably what I'm seeing rather than necessarily a collapse in equity risk. Anyway, moving on to the charts that matter. Let's go to That's a Sell Up. Bada bing, bada boom. Let's go to dollar yen. Boring. But range trading can be fun sometimes, especially if you're making money, Blake. I think this is an interesting one because some of the yen crosses are in a strong trend. If you like trends, go and have a look at the stocky yen, Swedish krona against the yen. That's absolutely going nuts at the moment. Aussie yen, less so, but I think that's probably got some upside. Some of the yen crosses are working quite nicely at the moment. But dollar yen obviously gets the front and centre. It's part of the dollar index, and that's just been trading this tight range. You can see, to the top end of the range, sellers come back in. You can see that last couple of days, longer wicks. But it's pretty well defined between that sort of 148.50 and 146.70 kind of range. I think there's conflicting forces. We don't really want to go long dollars with any kind of real conviction ahead of payrolls. Obviously, other factors playing through, but you can see that in Euro and the Dixie that upsides have just been capped into the 100-day moving average, and sellers are just not happy. Happy just to sell into levels. On the downside, there's not a million reasons to want to own the yen at the moment on this one at the moment. So we've got this really nice fair value. The market looks very, very comfortable for now in that range. It's just market's like an auction, right? And this is beautifully in fair value. The question is what changes there? Obviously payrolls numbers, the big one there. So right now I'm happy to trade the range, selling into the top end of the range, buying into the bottom ahead of payrolls. We have to see if some of that position comes out, some of that short dollar position comes out. But I suspect if you put a gun to my head, I've probably got some upside risks to this one. But I think when the breakout comes, I think it will be quite telling and quite powerful, and one that probably I want to be involved with.
Oh, I like it, Chris. And you had the exact same conversation or exact same setup with gold, and the same comments last week. You said, "Hey, a little comfortable in this gold range, but we're in a bullish trend. It looks like it's gonna, gun to my head, we're gonna be breaking out to the upside." And lo and behold, let's turn it to gold. Wow, I didn't mean for that to even rhyme, but it did. All right, let's take a look at gold, Chris, because you were looking at it last week. We were in that nice range, and then boom, we broke out. And the question that I've been getting, and the question I've gotten, I can't even put a number on how many times over the course of the last couple of days, is where's gold going? I mean, this is a bullish wedge breakout. Everybody's looking at it, which is also scary. The trend is very well entrenched. The 127% extension is it comes in just above 3,600. Any dip back to 3,500 and 3,450 are the levels that I would be interested in being long again. If I was going to be buying dips. If we continue higher and we continue to break higher, 3,750 is the 161% extension of the wedge. Chris, this is a bullish breakout, and you have to respect it as such. And I do agree that, come the jobs report, if let's say it's a strong number, gold gets a little bit of a haircut, the haircut's probably going to be limited to about 3,450 to 3,500. We get back down there, that's going to be the test for the bulls, and I think that's a level that you want to be buying again on any dip. So those are some upside targets that I think need to be looked at.
Yeah, I think it's an interesting one with gold. First thing I say to people is take your time frame out. Have a look at the chart since the 2022 lows. I mean, this is not a new phenomenon. It had a ripping trend for a long, long time. One way you can say, look, pullback's been pretty minimal. Obviously we've been consolidating since April in this consolidation pattern, which we've now broken out. But yeah, this is just a continuation of the long-term bullish trend that we've been seeing. And I think from an investment, there's great opportunities in gold, because it's what everyone sort of talks about, this idea that central banks are diversifying into gold assets and various factors, and real rates have been falling, dollar vulnerabilities, Fed cutting cycle, blah 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 blah. But the other thing for investment managers, which gets widely doesn't get a huge amount of airtime, is its correlation. It has no correlation, no statistical correlation right now with the S&P. It's got a very low correlation, in fact, a negative correlation with treasuries. So if you're an investment manager, you're saying, well, it's working, it does all these things that I like, credibility, dollar debasement, risk off. But most importantly, within a multi-asset portfolio, is it lowers the variance by having no correlation. So it's an uncorrelated asset. So that's really important. It's going up, does what it wants. So you put 5-10% in gold, and you've got that uncorrelated asset. So from an investment perspective, that correlation effect is very, very appetizing, and it probably gets less airtime than it should, because I think that's a really important one.
It is.
The NASDAQ as well. Let's bring up the NASDAQ, because this is an interesting one. It's less interesting than gold, I think, because gold's just in beast mode. But you can see the defined levels we got there. So, for me, I know people, if you're looking at sort of swing trading, or you're looking at it from a sort of a big picture daily chart, and we sort of work that into sort of lower time frames. But for me, the upside there, 23,754, is the level that the bulls want to break. Obviously, if we get a close below that, all-time highs are not a million miles away. It's just a smidgen below that. But that would be after this little bit of a reversal we've seen from that level. There's a few people now who've massaged those positions, very, very small amount of shorts. But a lot of people would be off sides, and they'd have to manage that. And I think a break of that level, and I think the NASDAQ could kick, and you might see that Goldilocks scenario playing through. It may surprise people because of these valuations that we talked about. Maybe Apple leads us higher, maybe tech finds its mojo again, semis work better, and Nvidia continues to kick back above, and gravitate towards $200. Maybe that's going to be the theme, I don't know. But on the downside, I think you've got that grey box sort of into 23,000, which, you've seen really good demand coming in there. There's been buying through there. So, it's a question, if we were to close below that level in the period ahead, that would speak volumes, because we've seen on a number of occasions, not a huge amount, 4 or 5 occasions, big buying opportunity. We can clearly see pictorially that people are happy to buy into that level. So if the market rolls over and that gives up, that would tell us a fairly emphatic situation. So for me, pretty neutral, modestly positive tactically, but I think obviously a break 23,754 above that pivot, turn tactically bullish, look to chase it long, and then obviously on the downside through that grey area, I think would be quite telling as well. So I think that those are the levels, line to define.
Lines to define. You know, I'm going to give you some of my own lines to define, and I'm going to take us over to the U.S. dollar Swedish krona. You know, this is very similar type of setup that Chris was just outlining with the Nasdaq 100. The Nordic currencies have been a lot stronger than I had expected them to be, or had anticipated them to be. I've been playing the U.S. dollar Norwegian krona off at the 10 level quite a bit over the last couple of months. And the US dollar Swedish krona is extremely heavy. It's trading right at support, and the support comes in at 935. The fact of the matter is, if you have a weak jobs report, if the data is decisively turning weaker, let's say, you know, unemployment ticks up to 4.4%, and we see only 10,000 jobs created, something like that, which is a very disastrous number as far as I'm concerned.
Yeah.
It would be, right? It'd be ugly. I mean, we would break through this 935 level. We trade down to the 905, which is the 161% extension, pretty quickly, and even maybe surpass that as a range extension would take us below 9. The flip side is, if we have a good number, you know, you get back above 950, there's plenty of upside back to the upper end of that range that comes in around 980. So you got a lot of upside to play with. If there's a good number, there's room to run. So I like this setup just because we're so close to a breakdown point that I think tomorrow or Friday could be decisive for this particular pair.
Love it. Yeah, I think the stock is doing quite well at the moment. Maybe it's a sort of a cyclical thing that it's got the end of rate cutting cycle that we're seeing some improvements to the other side. I don't know. Maybe it's just all of the above. But the stocky yen's been the superstar recently, and that's something I want to continue to participate on any kind of pullback. So interesting one. We'll see if that breaks out down to the top. I think this will probably break down to the downside. But obviously, it's conditional on payrolls. I think there's an interesting dynamic, Blake. I'm sort of going on, but Australia is seeing a turning point in its economic cycle. Better growth, early green shoots are the word. New Zealand's not. But then you've got Europe, which is still okay. I mean, France got issues, but it's been this idea that we're seeing slightly better growth from a low base point in Europe. Japan's all right. China's been doing okay recently. But the US, if we were to see that really weak payrolls number, which I say, who knows? But then that would put the US, and I think under the dollar smile theory, it would make selling dollars quite an easy trade and quite an obvious trade for me tactically in that situation. And dollar stocky would be one that you'd look at. But life's not too bad, as I say. The US data has been continuously beating expectations. It's not that bad. Anyway, let's move on to play du jour. I'm going to go for sterling against the Aussie. Obviously, I'm torn in this situation because I represent both passports. Anyway, look, I think, as I say, an interesting one yesterday because we did see the GDP numbers for Q2 coming out at 1.8%. I don't really look too much at GDP because it's such a backward-looking indicator covering a quarter, and we obviously look more into the future. But there is an interesting one. Q1 GDP was revised up a tick. Q2 came out 20 basis points above the street's expectation. And it does make me believe that now that the RBA's forecast for GDP by the end of the year is too low at 1.6%. I think we're probably going to go nicely above 1.8%. But what we're also seeing is domestic demand was okay. It wasn't just fiscal stimulus which has boosted up. We are seeing consumption at the backbone of this as well. And the private sector, which has been in the doghouse, may look to be seeing green shoots. If we have a look at the ASX earnings season, you've seen a situation where those domestic cyclical companies, those companies earning revenues or sourcing revenues 75% more domestically, massively outperform those international, those foreign-based cyclical stocks. And that's a really important situation as well. Now, with rate cuts still sort of expected in Australia, we're still pricing 25 basis or 50 basis points of cuts at the end of the cycle. But we are seeing better growth. And that's an interesting thing with fiscal still coming through. I think that, your rate cuts are capped on the downside. Obviously, we've got concerns around the feedback loop in the debt situation in the UK. And so I think that makes the Australian dollar reasonably attractive, certainly against the cross rates. And so I like selling this one. I think this goes lower. any kind of pop for me, and I'm getting short into this. And I think this, ultimately over time probably comes down to the 2 figure. So I still like that one. Euro Aussie was one we talked about last week. Thanks to the viewer question. That's been trading nicely downside, like Euro Aussie to the downside, Aussie yen to the upside. So it's not a consensus situation. I mean, Aussie Kiwi you can talk about. I'll be buying pullbacks in that one. But I think Aussie looks quite attractive from a tactical basis against the cross rates. Against the US dollar, it's more about the risk and 90% US dollar. But you could see a path easily where that goes up to 66 cents the year-to-date highs.
All I heard was green shoots out of Australia, and now I'm wondering if I chose the wrong currency. But my play of the day is going to be the Aussie Kiwi, Chris. And yeah, this is
that's a good level to sell at. I'll give you that.
It's a big level, buddy. And you notice that the long-term, multi-year 618 retracement, going all the way back to 2022, this whole range. When you're looking that far out and you're looking multi-years, whenever I see a key fib level, like that big red line that goes through the middle of the chart, you can be above it or below it by 100 pips, and it's not a big deal. It's in the vicinity, right? And so we're up in that vicinity, the 111.50 to 112 level that is constantly and consistently struck down the Aussie Kiwi. Now, you talked about green shoots in Australia and how it looks good on the cross as well. It's obviously been very much priced in, at least in the very near term, against the Kiwi. Now, one of the other things that I don't show you here on this chart is over the course of the last 2 weeks, we just completed a bull flag pattern, and it just completed over the last couple of days. So we're running into some major resistance. I have already sold it. I sold it at 111.49 today. Earlier today, our community already knew that I did that. But I'm not looking for, I'm not looking for a move down to 108. I'm looking for, maybe 100 pip move lower. But I know Chris, the reason why now, maybe I'll say 80, because I know Chris's bids are going to be down here buying pullbacks on anything on these Australian crosses if they come.
I am, I think selling. I'll be waiting for a little bit of retracement, going short sterling Aussie. But I think this is I think the significant dovish move recently from the RBNZ and the dynamics in the economy. Look, I mean, this pair has come into big resistance and reflects a lot of what we know now. So it will need to see something new to kick it through that obvious resistance. So I love your trade. Well, I call it a free money trade, but it's not, obviously. Can't say it just compliance-wise. But I like this, and I think there's a scalp in there for sure. Whether this turns out to be a trend reversal or something more deep-rooted, obviously yet to be seen. But I think there's money to be made scalping into such big levels there and what's being priced in there. But I think if you look at the other pairs that we're talking, sterling Aussie, Euro Aussie, the move's far less pronounced and mature than what we've seen in Aussie Kiwi. So that's what I'm saying with Aussie moves. You've got to be select on that situation in that. But Aussie Kiwi, interesting one. Yesterday, Aussie Kiwi was the third most open position that we had of any market. And that's very rare that you see that, considering. And so 90% of clients are short Aussie Kiwi at the moment.
Oh, no kidding. They got crushed post GDP
numbers. No, now. So I think it's just a reflection that this is not a particularly well traded one by the retail set, because it's generally a boring cross. It's a low beta grind. It's like sterling against the pound, right? And so when I saw it and I said, well, so many people are short and there's such a big, I was like, they've got to look at the daily, got to take out. And obviously that big resistance level, the fact that you've been on such a trend is music to a lot of people. So people are looking to counter this move now. So.
Well, best of luck to all of you Pepperstone traders out there that are short Aussie Kiwi with me.
Yeah.
So how about that?
I like it as well, mate. I'll jump in there. I just think there's going to be a pullback. So anyway, we're all on the Aussie Kiwi cross. Anyway, thank you, Blake, and thank you everyone out there. Happy Father's Day for you Aussie fathers out there tomorrow. I hope you have a good day. I'm going to be sitting on the couch after work with my 3 children, eating a kebab and hopefully sleeping a lot. Hopefully that's going to be the situation. Anyway, good luck to everyone out there. Enjoy the markets.